Next, let's talk about how to choose your business structure. Now, this is another key piece, and if I could say, if any three things were going to happen at the same time, it would be market research, your financial planning, and deciding what your business structure is going to be. Because choosing a business structure will also determine your financial plans and how exactly you're going to proceed, because you might actually have to include, things like filing fees and possibly, as a one-time fee, your annual state taxes. Some states, like the state of California, there's a mandatory $800 fee for LLCs or any incorporated business. So these are the sorts of things that you want to incorporate in your financial plan. Now, I'm not going to read the slides word for word this time. I'm just going to talk about each one. So the first thing I want to talk about is liability protection. If you are going into an industry that is considered high risk, maybe you're going into like consumable, if you're creating a food or beverage, I highly recommend you incorporate your business, because the last thing you want is for, God forbid, something to happen and then you get sued. Now, liability protection protects you and your assets. So if anything happens, for whatever reason someone tries to sue you, or let's say you take out a credit card in your name for the business and then you default on payments or whatever the case is, it's going to hit you personally. So to protect yourself from that, which I don't recommend getting a credit card unless you know you can make the payments, but to protect yourself from things like, lawsuits, you want to look into, limited liabilities or LLC companies. Next is going to be tax implications. Now, when you are a sole proprietor, meaning you don't file for any sort of business license, these are different from permits, but if you don't file, to be an LLC, you're a sole proprietor, which means that you are, a freelancer, independent contractor, whatever word you want to use, but you're going to have to pay self-employment taxes. Now, self-employment taxes are 15.3%. And that is a lot of money when, your sole income is your business. So if you are just doing, this is a side gig, that 15.3% might not be too bad compared to all of the money you might have to pay if you were an incorporated business, like fees to the state. But if you are an LLC, you actually get a little bit of a tax break. So you still have that 15.3% requirement, but you split that with your employee. So if you hire yourself as an employee, meaning you make yourself a W-2 employee, when you file your personal taxes, because with LLCs, for example, your business taxes get filed with your personal taxes, or as your personal tax. It's called a Schedule C. We'll get into that later. But if you were to hire yourself as a W-2 employee, you as the employee only pay that 7.6% in taxes, and the business or the LLC pays the other 7.6% or 7.65%. So, either way, the government's still getting their 15.3%, but here is the catch. So if you are a business and you are and you have those payroll taxes are actually a tax write-off or a tax deduction. So yes, you have to pay the 7 and change, but you get to write off the other half. So overall, you're only paying half of that 15.3%. So you can see the benefit there. Whereas if you were a sole proprietor or a freelancer, you have to pay that whole thing yourself. So it's just one example. Next is going to be ownership and management. If you have multiple people within your company who are going to be, managing members, you're limited on how many of these you can have based on the type of business structure. So if you are going to business with more than one person and you want to become an incorporated business, because not all partnerships have to be incorporated, you would have to see which is right for you. I believe the max is 100, so unless you plan on having things like board of directors and tons of employees, you might not really need to worry about this ownership piece. Cost and complexity. So things like corporations are going to be extremely complex. They're going to cost a lot of money, high risk, high reward. But, like I said before, being a freelancer or sole proprietor might be the most cost-effective approach, because you don't have to worry about paying your state fees. You don't have to worry about paying a filing fee or anything else that's going to be required to own and operate an LLC. But you are, again, there's a give and take. You're still going to be subject to that 15.3%. And last is future plans. It's good to consider this, but at any moment in time, you can transition your business to a different business structure. And these things are relatively easy, but I do recommend, if your business is growing and you want to go from, let's say, LLC to corporation, that you hire a business advisor to help you through this transition. And usually that business advisor will also elicit the help of a corporate lawyer. But some companies don't do that. Like, for example, Google is still an LLC. They started as an LLC and they've remained an LLC. It works sometimes. So next we're going to talk about the different types of structures and kind of, you can get an idea of the difference between all of them and which one might be best for you. Now for the different types of business structure. So you have an LLC, a limited liability company. That's going to be the crowd favorite. It's definitely my personal choice because all a limited liability company is compared to a sole proprietorship is just removing the liability from you. That's pretty much it. Removing the liability, you get a little bit of a tax break, and there's some other benefits that you have as an incorporated business. Because if you think about it, and I'll kind of put this in layman's terms, in the state of California, I had to pay $800 a year for all of my businesses that are filed here. So that is just the fee they charge each individual business. Now, they want to keep you in business because they want to keep that fee coming in. They still want you to continue to pay your business taxes. So, how do they do that? Is they give you tax breaks and things that you can do to write things off. A lot of big businesses, you'll hear of businesses that have revenue in the millions and billions and they're paying $1,000 in taxes. And how they're doing that is, tons of accountants and tax attorneys, but also because they have an in-depth knowledge of the tax law. Now, I go into tax law more in my business tax and compliancy course, but all you need to know is that your state and the country as a whole want to keep you in business. Small businesses are the backbone of our economy, so keeping you in business is a priority. And that's why there's all these loopholes and ways for you to save money, because they want you to stay in business. So that is the biggest difference, is you get all of these benefits and you get to remove the liability from yourself. Yes, you have to pay some fees, but if you rack up enough, write-offs and deductions, you really won't feel those fees. Now, a sole proprietorship, again, is just like an LLC, except the liability is yours. If anyone sues you, it's on you. It's on you personally, so all of your assets would be at stake. And this is still the case for an LLC, but there has to be severe gross negligence, and in the 15 years that I've owned a business, I've only ever seen this happen once. It's very unlikely. They even went back and rewrote tax law to ensure LLCs were covered. Next is going to be a nonprofit. So a nonprofit is an organization whose sole purpose is to operate for the public benefit. I'm not going to get into this too much. The government is extremely particular on who they allow to operate as a nonprofit. There are tons of benefits because you don't have to pay taxes, but your sole purpose and your mission is to give back to the public, whether that's communities, animals, whatever the case is. Your mission as a company is to not be profitable. Now, there are ways to pay yourself in this, but it is not going to be, a crazy salary. So if you have a multi-million-dollar nonprofit, you're not going to be making millions, but you could be making a decent salary, not as much as you would be if you had a multi-million-dollar LLC. Another thing I want to discuss here is you are allowed to pay yourself a salary within reason based on the profits. So as an LLC, you determine how much you make based on the profits and based on, what is. So I'll give you an example. If I am an electrician and I have my own electrician company, and the average electrician in my zip code in my area makes $50,000 a year, and my company profited $80,000. Should I pay myself that $80,000? No. You have to pay yourself within reason. And while the IRS makes this subjective, you still can't, take all the money away from your business. You want to stick close to the average salary of the person, of the industry that you're in. In this case, it would be the $50,000 electrician salary. Now, I also want to mention that if your business did not make enough money, so let's say, again, electrician company or electrical company, and my business made $10,000, I can't take the whole $10,000, but I can pay myself a portion of those profits. So you want to keep that in mind when you get into this, because that is not the case for nonprofits and not the case for sole proprietors. Sole proprietors, you can keep the whole thing, but you're going to pay taxes. So most sole proprietors don't pay themselves all of their profits. As a nonprofit, the payment structure is a little bit different. And I'm not going to get into that because there are some nuances, because it does depend on how you set up your nonprofit. Okay, so next we're going to get into a few other types of business structures that may or may not apply to you. The next type of business structure is going to be a partnership. Now, a partnership can be with or without liability. In this case, we're going to talk about without liability. So this could be, you going into business with your spouse, with your friend. As a general partnership, you both would equally share responsibility and liability of the business, from responsibility to liability if you were sued to profits. Now, if you go into an LLC type partnership where it's a multi-member LLC, you get to dictate which percentage or how much of a percentage each partner owns. You are limited on the number of partners, or AKA managing members, but you can bump that up if you are in a corporation. You can have, I think it's unlimited now, number of partners or shareholders. Next is going to be a corporation. I'm not going to get too much into this. Corporations have all the perks of an LLC, but they are just larger organizations. And you are heavily protected. As corporations are generally businesses that are going to grow exponentially and kind of bring in a decent revenue. That doesn't mean that as a startup you can't start as a corporation. You can absolutely start as a corporation, and you have tons of room to grow. However, starting a corporation has a lot of upfront costs. So for many people starting their business, corporation is not the way to go, because there are tons of perks that come with being a corporation, but there are also a lot of rules. So just keep that in mind. Next are going to be cooperatives. Cooperatives are going to primarily be, going to be like your farms and agriculture. So cooperative is a type of business structure in which the owners are also customers or users of the goods or services provided by the cooperative. And the only time that I've seen this as a business consultant or advisor has been farms in which the individual actually lives on their farm, and kind of like lives off the land, but also is producing produce to sell. This is extremely unique, but if you are interested in opening up a cooperative, I highly recommend you speak with a corporate attorney who is going to, be able to give you more information of all those stipulations and that go into opening a cooperative.